Hello everyone, this is Nitish and today I will teach you chapter 4 of Economic Survey 2022-23. Today is episode number 4 and chapter Monetary Management. This will be helpful for this year UPSC exam, but before starting this class, I would like you to please subscribe the channel and also like and comment on videos. These contents are free of cost, so for test series and foundation video, you can contact to Vice Sir on WhatsApp 7200 681 675. So let's begin. First is the introductory part. The year 2022 witnessed high inflationary pressures on advanced as well as emerging economies. This led to an unprecedented, synchronous and sharp cycle of monetary tightening across countries. So, the RBI in financial year 23 has changed its policy stance to moderation of surplus liquidity condition. This was followed by an increase in lending and deposit rates. The high GSEC bond yields, GSEC means government security, moderated in December 2022, which is aided by lower oil prices, a slow pace of rate hikes, and general moderation in global sovereign bond yields. Amid this global tightening cycle, India has shown resilience. Like the domestic appetite for credit has been on upswing. Non-food credit offtake by scheduled commercial bank has been growing in double digits. Credit disbursed by NBFC, which means non-banking financial company, has been on rise. The capital to risk weighted asset ratio of scheduled commercial bank remains healthy at 16.0% and well above the regulatory requirement of 11.5. So we will use this short form, that is CRAR, in the upcoming slides. So please remember its full form, that is capital to risk weighted asset ratio. The recovery rate for scheduled commercial bank through the insolvency and bankruptcy code was highest in financial year 22. So these are the factors, or we can show that how the India has shown resilience amid this global tightening. Continuing with the introductory part, the increased outreach of the banking sector and capital market is reflected in the insurance and pension sector. Insurance penetration in India has been steadily increasing, with life insurance penetration being above the emerging market and global average. So, as I told you that the insurance penetration in India has been steadily increasing. So here is the catch, because if this statement is put in the prelims examination, so here you have to mark true statement that the insurance penetration in India has been steadily increasing. Timely government interventions and a conducive regulatory environment have supported the growth of the insurance market. RBI support to growth will ensure adequate liquidity in the financial market. The growth in credit offtake is expected to sustain and combined with a pickup in private capex, that is private capital expenditure, that will usher in virtuous investment cycle. This will also be aided by constant monitoring of risk in the financial system by the regulators and their effort to contain them. Next topic is regarding monetary developments. As retail inflation crossed the upper limits of RBI's tolerance band. So first point is regarding RBI's tolerance band. The Monetary Policy Committee maintained a status quo on the policy repo rate between May 2020 and February 2022 after implementing a 115 basis point reduction between March 2020 and May 2020. The MPC, which is Monetary Policy Committee, in April 2020 introduce the standing deposit facility. So here the question can arise in the prelims examination in the form of a statement that the standing deposit facility was introduced in year 2015, 2016, 2017 and 2018, because these are very common years in which multiple initiatives are taken. So here you have to understand that all the statements, all the years are wrong, because standing deposit facility was introduced in 2022. So if the statement is given that the standing deposit facility was introduced in 2022, then this statement will be true. Standing deposit facility allowed for the deposit of excess fund by banks with the RBI without the necessity of collateral in the form of government securities, thereby allowing effective liquidity management in a collateral-free manner. Now, let's look at this chart. Here it is regarding policy rate, which means the dotted black line is representing fixed reserve repo rate, The green line is representing repo rate, the orange line is representing SDF rate, which means standing deposit facility rate, and the red line is representing MSF rate. So as I already explained you how to study the charts or the graph, that you have to look at the trend. So please follow this graph and look at the trend and identify which is steadily increasing, which is steadily decreasing or not. Here you can see that the line of SDF rate is basically taken from April 2022. So the question arises why? Because as I already told you that the standing deposit facility rate was introduced in April 2022. Now move on to next point in monetary development. Reserve money, which is represented by MO, and broad money, which is M3. So reserve money is increased by 10.3% year on year as on 30 December 2022 compared to 13% last year, whereas broad money stock increased by 8.7%. Next point is regarding liquidity condition, that the surplus liquidity condition that prevailed post-COVID has been moderated during financial year 23 in consonant with the change in the MPC stance. MPC means Monetary Policy Committee stance. Next point is regarding monetary policy transmission, that the lending and the deposit rates of bank increased during financial year 23 in consonance with the policy repo rate change. And the last point in monetary development is regarding development in G-Secs market, which is government security, that the monthly average yield on the 10-year government bond stood at 7.3% in December 2022 after having peaked at 7.5% in June 2022. Now move on to next topic of this chapter, that is banking sector. So first point is regarding 4R approach, that the government and the RBI have adopted calibrated approach of implementing 4R approach, which means recognition, resolution, recapitalization and reform to clean and strengthen the balance sheet of the banking sector. The asset quality of scheduled commercial banks have been improving steadily over the years across all major sectors. Next point is regarding CRAR. As I already told you that the full form of CRAR is capital to risk weighted asset ratio. So with the pickup in lending activities during financial year 23, CRAR moderated in September 2022 because of an increase in risk weighted asset. So from the bar graph you can understand how it is possible. The reference is taken from March 2020 to September 2022 and it is regarding the four sectors, that is PSB, PVB, FB and SCB. PSB means public sector bank, PVB means private sector bank, FB means federal banks and SCB means scheduled commercial bank. Now next topic is regarding credit growth. The recovery in economic activity in financial year 23 along with the enhanced financial soundness of banks and corporates has bolstered the expansion of non-food bank credit since June 2021. Next is regarding agriculture and allied activities, that is the credit to agriculture and allied activities gained momentum supported by the government's concessional institutional credit and higher agriculture credit target. Industrial credit growth has been buoyed by a pickup in credit to MSMEs assisted by the benefits accrued from the effective implementation of emergency credit line guarantee scheme and the support provided by the government's production linked incentive schemes and improvement in capacity utilization. Credit growth in services was driven by a recovery in credit to NBFCs, that is non-banking financial companies, commercial real estates and trade sectors. So this is basically given in your economic survey regarding credit growth. Now next is NBFCs, that is non-banking financial companies. The continuous improvement in asset quality is seen in the declining GNPA ratio of NBFCs from the peak of 7.2% recorded during the second wave of pandemic to 5.9% in September 2022, reaching close to the pre-pandemic level. With the decline in GNPA, the capital position of NBFCs also remained robust with a CRAR of 27.4% at the end of September 2022, slightly lower than 27.6% in March 2022. Now let's look at the graph. This graph is representing the declining GNPA ratio is to improvement in asset quality of NBFCs across sector. So here we can see that the improvement in asset quality of NBFCs across agricultural sector is 1.6%. Similarly, if we look at the industry sector, that is 46.2%, service sector 27.4%, personal is 23.5%, and other is 1.2%. Now the question arises that that you have to learn this data or not. No, you don't need to learn this data. You have to only understand the trend that in the industry sector, improvement in asset quality of NBFC is highest, and in the lower part it is other sector. Now move on to the next topic, that is regarding insolvency and bankruptcy code. So I will explain you with the help of basic diagrams. First is regarding CIRP. What is the full form of CIRP? Corporate Insolvency Resolution Process. So this chart basically represents the CIRP's status since inception. So if we look at the left hand side box, we can identify that the CIRPS commenced 5,893 cases, out of which the closed cases are 3,946 and the ongoing cases are 1947. Out of the closed cases, 846 are closed by appeals or reviews or settled, 740 by withdrawals, 1807 by liquidation, and 553 through resolution plan. So this is the first chart regarding insolvency and bankruptcy code. Now move on to the next pie chart, that is regarding sectoral breakup of ongoing CRPC in manufacturing sector. So here you have to understand the catch that this pie chart is regarding manufacturing sector. So multiple things are given in this pie chart. No need to learn everything. You have to only learn in which sector CIRP is the highest and lowest. So here we can see that in the textile, leather and apparel product, the the ongoing CIRP is 16%, and similarly in basic metal it is 16%. So these two sectors are the highest one. Now consider the least sector, that is fabricated metal products, that is 4%. So you have to only learn this. Next pie chart is regarding service sector. So here once again you have to identify the highest and the lowest. So the highest one is in real estate, renting and business activity, that is 60%, and lowest one is in hotels and restaurants. Now next is outlook, which means we can also say that the concluding part. The resilience of domestic financial system is reflected in the healthy balance sheet of banks, a strong capital level of NBFCs, and robust growth in AUM of the domestic mutual fund. So here AUM is nothing but the asset under management. India is one of the fastest growing insurance market in the world and is expected to emerge as one of the top 6 insurance market by 2032. So here the catch is the year 2032. In the statement it is written that the India is expected to emerge as one of the top 6 insurance market by 2030. So this statement will be wrong because it is mentioned here in the economic survey it is 2032. As India's transition to a high middle income country, its pension sector has tremendous scope for growth. So this is the concluding part. Hope you like this video and my content. So please like and comment on videos, subscribe the channel. Thank you.